start with the real question. When people say dollar cost averaging stopped working, they often mean something more emotional. They kept contributing, the account still went down, and the effort no longer feels rewarded. Dollar cost averaging is simply the habit of investing equal amounts at regular intervals, regardless of the current market mood. It can reduce the pressure of choosing one perfect entry point, and it can make behavior more consistent. It does not guarantee profit, protect a weak investment, or turn every month into a positive return. In this video, we are not deciding whether you should continue, stop, buy, or sell any product. We are separating three layers: the mechanics of the strategy, the quality of the investment plan, and the expectations you brought into the plan. The first check is the asset itself. Dollar cost averaging works best when the thing you are accumulating has a clear long-term role in your portfolio. That might mean a diversified fund, a retirement allocation, or another instrument that you understand and can hold through cycles. If the investment is a narrow theme, an expensive product, or a story-driven trade, a falling price is not automatically proof that dollar cost averaging failed. It may be proof that the object being averaged into was never suitable for the job. Before blaming the schedule, look at holdings, fees, sector concentration, tracking rules, and the role of the asset. Ask a simple question: if the price fell another 20%, would I still know what I own and why it belongs in the plan? The second check is time horizon. Many investors say they are long-term investors, but judge the strategy with a 3-month scoreboard. Dollar cost averaging spreads entry points across time. It does not make a short-term goal safe. If the money is needed for tuition, a home purchase, taxes, or any near-term commitment, the problem may not be discipline. The problem may be that short-term money was placed into a high-volatility asset. On the other hand, if the money is intended for a 10-year or 20-year objective, a temporary negative return is not automatically a failure. It is a stress test of whether the plan, the cash flow, and the investor can stay aligned while the market is uncomfortable. The third check is cash flow. A strategy that looks rational on a spreadsheet can fail in real life because the household budget cannot support it. If emergency reserves are thin, employment income is unstable, or insurance and family obligations are not planned, any downturn can force a pause or a sale. That is not a market timing problem. It is a financial sequencing problem. Before asking whether this month is a good entry point, ask whether the contribution amount is sustainable in a bad month. Separate living expenses, emergency reserves, short-term goals, and long-term investing. A smaller plan that can survive stress is often more useful than an aggressive plan that collapses at the first drawdown. Now separate strategy from expectation. Dollar cost averaging manages entry point risk. It does not remove market risk. When prices fall, the same contribution buys more units. That is part of the mechanism. But the total account can still be down, especially early in the journey. That is also part of the mechanism. Investor education sources such as investor.gov and FINRA describe dollar cost averaging as equal investments made at regular intervals. The important word is regular, not guaranteed. If your hidden expectation is that a disciplined schedule should make every statement look better than the last one, the expectation is the issue. The strategy may be doing exactly what it was designed to do while still feeling uncomfortable. A common mistake is comparing every dollar cost averaging decision with lump sum investing as if they answer the same question. Lump sum investing asks what to do when you already have a large amount available. Dollar cost averaging often asks how to invest recurring income in a disciplined way. Those are related but not identical problems. Vanguard and other investor education materials often note that lump sum investing can benefit from more immediate market exposure when markets rise, while dollar cost averaging can reduce the emotional and timing pressure of entering gradually. The right comparison depends on the source of the money, the risk tolerance of the investor, and the purpose of the portfolio. Do not declare a payroll contribution system broken by judging it as though it were a one-time windfall decision. There are situations where adjustment is reasonable. If the fund or ETF no longer matches the original goal, if concentration risk is higher than you understood, If fees are too high, or if your time horizon changed, the plan deserves review. If the monthly contribution forces you to use credit cards, drains emergency reserves, or creates constant stress, the contribution amount may be wrong. If the asset was chosen because it was popular rather than because it fit the allocation, the asset may be wrong. These are strategy problems. They should be repaired through asset allocation, contribution sizing, or product selection, not through panic decisions based only on the latest price movement. There are also situations where the urge to adjust is just emotion. A few months of losses, frightening headlines, or the feeling that everyone else is doing better are not enough evidence by themselves. A disciplined plan needs review dates and review rules. For example, review every 6 months whether the goal still exists, the time horizon still fits, the product still follows its mandate, fees remain acceptable, and the allocation has not drifted too far. If none of those rules are triggered, changing the plan every time the market is noisy may destroy the very disciplined dollar cost averaging was supposed to create. If you are currently losing money, use a 3-column worksheet. In the first column, write strategy evidence, asset quality, diversification, fees, concentration, and allocation. In the second column, write cash flow evidence, income stability, emergency reserves, near-term spending, and whether the contribution amount is sustainable. In the third column, write expectation evidence, how soon you expected gains, what drawdown you can tolerate, and whether you are treating normal volatility as permanent loss. Once the columns are separated, the answer is usually more precise. You might keep the plan, reduce the contribution, rebuild cash reserves, change the product, rebalance, or extend the horizon. The answer is not automatically stop or continue. The harsh truth is that dollar cost averaging is not a repair tool for every bad decision. Averaging into a poor product can compound the mistake. Averaging into a concentrated theme can increase risk at the exact moment you feel most committed. Averaging into a portfolio that does not match your goal can create the illusion of discipline while moving you away from the real target. This is why the plan needs disconfirming evidence. Decide in advance what facts would make you review the strategy. A mandate change, a fee change, a goal change, a time horizon change, or a cash flow shock. Price alone is information, but it is not the whole diagnosis. A practical version of the system has 4 steps. First, protect short-term needs before investing long-term money. Second, define the asset allocation rather than chasing a single popular product. Third, set a contribution amount that can survive a weak market and an ordinary life emergency. Fourth, use scheduled reviews instead of daily emotional checks. At each review, ask whether the goal is still valid, the time horizon is still long enough, the asset still fits, and the household cash flow still supports the contribution. If the answer is yes, the plan does not need to be rewritten every time prices move. So, did dollar cost averaging stop working? Usually the answer is not a simple yes or no. It may be working mechanically while your expectations are unrealistic. It may also be unsuitable because the asset, time horizon, or cash flow was wrong from the beginning. The value of the strategy is discipline, not certainty. Separate what you own, how long you can own it, and what money is funding it. Then decide whether to change the strategy or change the expectation. This content is educational perspective, not personal investment advice. Investing involves risk, including possible loss of principal, and your own plan should reflect your goals, constraints, tax situation, fees, and risk tolerance. Also consider position sizing. Not every recurring contribution deserves the same risk level. A household might place most monthly contributions into a core diversified allocation, keep a smaller satellite sleeve for higher risk themes, and reserve some cash for annual rebalancing or rebuilding emergency savings. This is not a recommendation for a specific percentage. It is a way to think about roles. Core money should support the main goal. Satellite money should be small enough that being wrong does not damage the household. Cash should protect decision making. Dollar cost averaging into each sleeve without defining the sleeve is not discipline. It is automation without judgment. Another useful question is opportunity cost. In a rising market, a gradual entry plan can feel frustrating because money held back may miss gains. That does not prove the strategy failed. It means the investor paid a behavioral and timing cost for a smoother entry. For a large lump sum, that trade-off should be evaluated deliberately. For monthly salary income, the question is different. The cash did not exist before payday, so the real choice is whether new savings move into the long-term plan or disappear into spending. Mixing these two situations creates confusion. A payroll investment habit and a lump sum deployment plan are cousins, not twins. Finally, do a pre-commitment review before the next downturn. Decide the maximum contribution that can continue during a weak year. Decide which assets are core and which are optional. Decide which facts would make you stop, reduce, rebalance, or replace a product. Decide how often you will review and what information is allowed into that review. If the rule is simply, "I'll keep buying unless I feel bad," the rule will fail exactly when it is needed. If the rule is tied to goals, time horizon, cash flow, and product quality, the investor has a better chance of acting consistently without pretending that risk has disappeared. The final test is language. If you describe the plan as "I am buying because it always comes back," the plan is too vague. If you describe it as "I contribute a sustainable amount into a diversified long-term allocation, review it twice a year, maintain emergency cash, and rebalance when allocations drift," the plan is much clearer. The second sentence may sound less exciting, but it contains real control. It names the amount, the asset role, the review cadence, the cash reserve, and the adjustment rule. Dollar cost averaging is strongest when it is embedded in that kind of system. Investors should also avoid turning the strategy into identity. Some people keep contributing to an unsuitable product because stopping feels like admitting a mistake. Others abandon a sound plan because temporary losses feel embarrassing. Neither reaction is disciplined. Discipline means following a defined process, including the process for changing your mind. If the evidence says the product, contribution size, or time horizon is wrong, change it. If the evidence says only that the market is volatile, do not pretend volatility is new information. A useful closing question is this: what would make this contribution plan successful even if the next 12 months are uncomfortable? Possible answers include a stable emergency fund, a contribution amount that can continue, a portfolio that matches the goal, review rules that prevent panic, and a risk level the household can actually live with. If those conditions are absent, the plan needs work before the next downturn. If those conditions are present, dollar cost averaging can do its real job, turning recurring savings into long-term exposure without requiring a perfect market timing decision every month.